Hey guys, this is Shane Harder here from Seeking Unemployment. This is the real estate investment show where we learn how to become gainfully unemployed together. So today is episode 4 of a much larger series where I go about asking all kinds of different investors from different walks of life, different parts of the country, and different asset classes how they are handling the same exact issue. So today's issue is recognizing a good deal. So how do they decide this deal gets a thumbs up while others may get a thumbs down? And yeah, how do they look at that? Are there specific metrics they're looking for? Are there specific deal elements they want to see? And so without further ado, let's see how they handle these.
I have a lot more metrics depending on the type of specific investment. Um, I don't just say I need like X number of dollars. It's like I need X number of dollars for this area and with this particular property because it only has this much in it or has the potential to have that much in it. So it's a little bit more. I will say I go for wins, stuff that is when I look at it, I have zero problems looking at it and be like, yeah, I'm not gonna fail on this one. I can
Okay.
make all the mistakes necessary, but that's me. I'm super cautious. I don't think the average person should be like that by any
Yeah.
means.
Yeah.
I am just that way because I am neurotic.
Yeah.
But the standard stuff that I won't consider is I need it to hit the did my headphone deck and my headphone deck. I need it to hit the standard flippers margins. So I want 30% equity in my ARV. Um, we can talk 20% equity, even 15% equity if it's cheap, but it has a really high cash flow. The real number I'm looking at is what time it's going to take for me to recuperate these funds. And I'm mostly focused right now on just shortening that time.
Hmm.
Short that time as much as possible, and beyond that, how much more cash can I push beyond several $100 a month per property? No, I don't have a very specific metric. I'm also dabbling in just such different types of properties. But I'm getting closer on those metrics on the specific types of properties.
It depends on what I'm going to do with it, right? If I'm wholesaling it, all I have to know is what my buyers are willing to do so that I can structure that type of a deal. So for instance, if I have buyers that are willing to do something for as little as a $20,000 profit, and I wanted to make $5,000 on that deal, I just had better get that property to where after purchase price and after rehab, it will clear. And after all my closing costs and everything, it'll clear 5,000 for me and 20,000 for them. Right. So wholesale deal. And then you might have some cash buyers that don't want to look at anything under $50,000. So just whatever, you have to know their numbers in wholesaling. If I'm looking at a rental property, my metrics typically are fairly low compared to a lot of investors, but I would prefer a $200 a month cash flow. So clearing $200 after all my expenses. And I would like to have a 10% cap rate with a 15% cash on cash return. So those are my numbers on a rental property. And then for a fix and flip, because I'm having to devote time to it, crews, overseeing the crews, just making sure it's all going well and everything, then I typically want a little bit more profit in that. Otherwise, I'd just wholesale. And so my numbers on that typically are, I would want to see about a $40,000 or more profit. And so now around here where we live, people might even have higher numbers than that for profit because the economics of it might be a little bit better. But where I'm dealing, that's typically the numbers I'm looking for.
That's an interesting question because it really depends a lot on your strategy. So for example, if I go to a tax deed auction, when you go to a tax deed auction, you're looking to steal properties. You're not dealing with a homeowner. You're dealing with a county. They have no emotional attachment to these homes. And so some of the stuff that I teach, depending on the neighborhood, there's times where I won't pay more than 20 cents on a dollar for a property. So if it's worth 100 grand, my maximum bid would be $20,000. A lot of times, one of the things I really like to teach my students is that a lot of us are really focused on price. A much more important thing in a lot of cases would be terms. And so let me give you an example, Shane. Let's say you see a home that if it was appraised, it would be worth $100,000. And the owner was asking $1 million. Would you ever pay $1 million for a home that appraised for $100,000?
No.
And that's what most people would say. But let's say the owner of that home said, listen, I want $1 million, but you just have to pay me $1 a month for the next 1,000,000 months. And let's say that property rented for $1,000. So now you could create $999 worth of revenue every month. It doesn't matter. It doesn't matter what you pay for the property. It only matters, what you pay for it and what you sell it for. So what matters in between is what are you going to do with that property while you're holding on to it. And so if I could get a property where I'm paying $1 a month to own it, and I could create revenue from it, then I don't really care what the price is. I care more about the terms. What's it going to put in my pocket while I'm holding it? And if it's creating that kind of revenue, probably I never want to sell it anyway. I'll take 1,000 of those. I'll take 1,000,000 of those.
Yeah.
And so you always want to look at the terms. I don't necessarily always have to have a great price where it's way under market value, although most of the time that's a goal. But sometimes let's say I have an owner who's if they were willing to give me 100% financing, where I don't have to, if let's say I was somebody who didn't have good credit and couldn't go to a bank to get a mortgage, but they're willing to carry me and they become the bank for me, that might open up an opportunity I wouldn't otherwise have. So maybe I would offer them full price, or maybe even a little bit of a premium if they're willing to work with me. And so it's not always the price that determines whether it's a deal or not. So one of the things you really have to, if you're going to be a real estate investor, is you've got to really be open-minded to kind of the big picture. Hey, what can I do with this property? And price is obviously something that is the first thing that pops up in most people's mind. But for me, it's usually the terms of the deal. What does it look like? And what does it put in my pocket at the end of every month? And so you kind of have to look at that big picture. But in general, if I'm buying at the auction, I obviously want to get a deep discount, because a lot of times you can't visit the properties. You're kind of guesstimating what it needs based on the research that you do. And so I always want to err on the side of caution. If I can go look at a home, it's really going to depend on the type of neighborhood, exit strategy. Sometimes I can get into a house and I know I've already got a buyer for it. I might be able to flip it without doing anything to it. And it's a really quick paycheck. All these things are going to influence your decision on what you're willing to pay for a home.
I'll just share how we looked at our deals, and we were able to buy 4,000 units since 2007. Couple of things. So first of all, we look for a problem. So if you find a property that is running really well, you don't see any opportunities to go in and add value, the rents are as high as they can be, the owner's happy, he's not motivated to sell, don't, in my opinion, look for the next deal, because there are plenty of other folks that are very motivated, and there's a real problem to be had. Now, nobody's perfect, and there's always some problem, but there's bigger problems and smaller problems. So I'll just share. The other thing I'd say is that the group that is closest to the deal wins. So if I'm in a market and I have been in touch with the owner 6 times, I've sent him mailings, he trusts me. We talk every once in a while. I share maybe a piece of advice in the industry, and he has a change of heart, and he now goes, I now want to sell my property. And you are out of the market. You have not been in touch with him. Guess who's getting that deal? It's me. And so it's like insider trading. Insider trading on Wall Street is illegal. In real estate, it's how you win, right? It's totally legal. If I know information that you don't know, I win. And so it's whoever's closest to the deal. So if you have a way of building relationships with the owners, that's the key. So I'll share one deal. This is the second apartment community we acquired in Kansas City. It was a 96 unit deal in 2009. And we were working on that deal for a year or so. I would call the owner. She was out of Florida frequently. And she just couldn't make up her mind. She didn't want to sell. And so then one day, I got the oil changed at my car. And I went in there and I looked at the newspaper. This was when, Craigslist was still newer and a lot of deals still came through on newspaper. And I saw a little ad in there. It said 96 unit apartment community. Well, I knew in that market, there's only one 96 unit apartment community in that market. It was a sub market of Kansas City. So I knew it right away. So I called, got through, and they had some family changes, and we basically put that deal together. We paid full price, but we paid $15,000 a door for that property, $1.4 million. And today it's, worth 6 or 7 million, and we've cash flow for,
Nice.
11 years. And it's been one of our best deals. And we won that deal because we were the closest to it. So that's the lesson. I think if I'm starting out or I'm trying to learn, really ask yourself, if there's a deal here, right? Why would it go to me? And I think some people think that deals just kind of randomly go to people. And it's like, well, I happen to get this deal. No, that's not how the world works. The world works that there's a lot of logic behind it. And so you have to be the person, the buyer that is the right buyer for that deal. And if you are, the deals will find you.
Kind of depends on what my exit strategy is, but I'll just use a buy and hold example. I really have a few different filters that I put it through. So if somebody might call me and say, hey, I've got this off market deal. This is the cost. This is the rehab, and this is what the rent is, right? Those are three of my big indicators. I want to know my all in, and I want to know how much I'm going to get every month in rent. I happen to like duplexes because, I have a couple single families too, but I really like duplexes because I feel like if you pay $60,000 for one door, or let's say you pay $80,000 for one door, you can probably get two doors for less than 160, right? So the ratios are a little bit different. Yeah. So I like duplexes. Some people don't. Again, it depends on what type of investor you are.
Sure.
But the things I really want to know is I want to know what's my purchase cost, what's my rehab cost, and what's my all in, and what's it going to rent for. The immediate question that I look at is, you always hear the 1% rule. And I know it can be a little outdated. But if somebody calls me and it doesn't meet that 1% rule, like right out of the chute, I'm like, probably not going to be a good deal. But I do put the time into it because I found a lot of cases where it doesn't meet that 1% rule. But what I find is the owner is an 85-year-old person who's had the home for 50 years, and she charged her nephew $500 in rent for the last 22 years, and it's way under market, right? So I do the investigation, because although it might be less than 1% right now, I want to look at it and go, whoa, they're getting $500 in rent, and this thing would rent for $950, right? So you do kind of got to put a little bit of time into it. But an initial indicator for me is it doesn't meet the 1% rule. After that, if it meets the 1% rule, or if it's close, then I'll kind of go on to the next filter. And the next filter for me is I basically take all of the expenses, and including mortgage, and I subtract all those expenses from my all-in rent. And am I going to cash flow? It's a really, really simple answer. Like, does this place cash flow? And for me, I like to have kind of the number I want to go for is I want to cash flow at least $200 to $250 per door. And that's kind of just my number. And everybody has a different one. In California, right? I talk to investors. I go, dude, I'm cash flowing $100. And you're like, okay, great. And they're super happy. That doesn't really give a lot of extra money if something were to go wrong, or putting aside money, right? So markets are different. I like to cash flow $250 a door, somewhere in there. And those are the kind of real basic numbers, and everything can change, but those are the basic numbers that I look at.
There is. So a lender will not lend on less than a 1.25 debt coverage ratio, meaning that the cash flow from the property has to cover the debt service by 1.25 times, if that makes sense. So we look for a high debt coverage ratio, ideally up around 2, sometimes more higher than that. 1.5 is kind of where we start to consider a deal. So there's the debt coverage ratio, and then those are really, and then there's the cap rate, and we could spend a lot of time explaining how the cap rate formula works and how the apartment buildings are valuated. And it's very important information. We don't have time to go into it right now, but we do look at what the net operating income is based on their current financials and what it's selling for, what the list price is, what we would have to pay for it. And we run that formula, the net operating income divided by the list price, and that gives us a percentage, which is usually anywhere from 4 to 8%. And that's called a capitalization rate. The lower the capitalization rate, the higher the price. The higher the capitalization rate, the lower the price and the better the deal. So if I'm looking at a deal and it's an 8 cap based on current financials, heck yeah, I'm way interested in that. Way interested in that. If it's a 7 cap, I'm still interested. If it's a 6.5 cap, that's kind of like 6 to 6.5 is kind of where the threshold is for something that's going to cash flow well. So that's a good first look. Basically what you're getting is you're getting an offering memorandum usually, and then you're getting financials, what's called a T12, the trailing 12 set of financials, and a rent roll. And that's what you can use to analyze and underwrite an entire deal. So if a deal passes those initial first glances, then we put it into a spreadsheet that we use that breaks down everything in fine detail. And that gives us a really good look, accurate look, hopefully, at the what the cash flow is going to look like throughout the holding of the investment, and what the cash out might look like on the back end in 2 to 5 years if we refi or cash or sell. So that's really it.
I've got general rules of thumb that I follow, right? The general rules of thumb just kind of let me know if this deal is worth digging into deeper. And then I've got more like precise numbers that I look for when doing the deeper dive. So for example, if I'm going to do a flip, I want to make minimum 15 to 20,000 profit, right? If it's not going to net me 15 to 20,000 profit after all the work and effort that goes into it, then it's not worth it to me as a flip, right? And so I'll quickly back into the numbers. If someone calls me and they say, hey, this is, XYZ property, I'd like to sell it for $100,000, right? I'll quickly back into the numbers. I'll get the ARV and say, okay, ARV's 200, they want 100. It's going to cost me 50 to fix it up. It's going to cost me 15 grand in realtor fees and closing costs. What's left? Is that enough for me to do the deal, right? If that meets the litmus test, then I'll dive deeper and kind of figure out, okay, go look at the property, figure out what it's really going to cost to fix it up, right? Do a deep dive into the comps and see what I could really truly sell it for, and then kind of, but the other rule of thumb I'm looking for on a rental or a flip is I want to buy it at 70% of the market value, right? Minus the repairs it's going to take to fix it. I feel like 95% of the time, if it hits those numbers, you've got multiple exit strategies. You can rent it, you can sell it, you can do whatever you need to. So if you can get a 30% discount, and then minus the repairs, you're in pretty good shape.
Well, so what kind of deal are we talking about? Flip or buy and hold?
Great question. Can we do both? Do you have time for that?
Of course.
Okay.
Yeah, absolutely. So a lot of people have like a metric and they want to do like a certain percentage of ARV is what they want for profit and all that stuff. To me, my flip income is to help me buy more rentals. That's the reason I'm doing flips, is to buy more rentals. And so I am more looking for 20 to 25,000 in profit out of my flips than I am like, oh, it has to be like 12% of what the ARV is or something like that. There's nothing wrong with that. It's just, to me, it's like, it's too complicated. I'd rather just think, is this worth me spending 3 or 4 months with to get 25,000? Yes, great. I'll do that. And if it's not, like, they're early on, I was very deal hungry and I was willing to take anything. And there were times when I just like almost barely made money. Like I made $3,000, you know, like it was like, that was not fun. So now my criteria for buy and hold is very different. Because I am not here to say just buy anything. What I am here to say is that most people are only looking at one of the 3 ways you make money on real estate when they're going to buy it, and base their entire decision on that. And that's usually cash flow. So I'm a fan of cash flow, don't get me wrong, but I have been, in 2018, I bought 4 rentals, and 2 of those rentals just broke even. And I walked in eyes wide open, like knowing these are just going to barely break even, because I use property management. So there was expenses, right? And I'm just like, and I had kind of high interest rates, but I knew the areas. They were areas that I like to invest in. And I was okay if like every now and then I had to put $100 in the pot, you know, like if it was like it, but that's how close it was. I mean, it was not like some great deal. But again, time is what makes it a deal. And so like, as I've held them longer, I've gotten lower interest rates in refis, the rent has gone up, you know, I've gotten more equity in the homes, I'm getting depreciation on my taxes. I mean, there's all the ways. And so I just try my best to keep a long-term, like if I hold this for 10 years, does this make sense? Yeah. Maybe year 1 and 2, I'm not making hardly any money, but like, does that matter? And for me, I'm not trying to quit my job and live off passive income yet. So I'm okay if my passive income's a little lower, but it's building up and it's going to be a better deal. So I'm a lot more liberal with what I will buy, as long as I can get really close to that break even with property management.
All right, guys, that wraps up this video. If you'd like to connect with us and partner on some multifamily deals, click on the link below and we can send you all the info on how to get started there. If you'd like to check out the videos from the beginning of this playlist, click on this link right here. To check out the link that Google wants you to watch, click on this link right here. And lastly, if you want to make sure you see the future videos that we'll be posting in the same series, click on this subscribe link right here. You'll be all set to go. Thank you so much, guys, and we'll see you on the next one.